Thank you, Professor, and thank you, Shanta, for that fabulous introduction, which has also sparked some nostalgia in me, because, I mean, intensive intellectual debates are the last thing you can expect in most Indian higher education today. I mean, given the way the culture is developing in these disastrous directions. But, so I've got a kind of deep nostalgia for that period, and I don't think it's necessarily peculiar to JNU. It's just that JNU happened to be the campus in which we all met. And it was our kind of fortune that all these destinies crossed each other in a political conjuncture at a time which was so exciting in the country. Things could have developed very differently from the way they actually did. Okay, this is the Isaac and Tamara Deutscher Memorial Lecture, which I gave at an HM conference. That's a historical materialism conference in London last year. So I hope you don't mind that I'm just rehashing a lecture which I've given. The first appearance of the term fictitious capital in volume 3, that's volume 3 of Capital, is in the heading of chapter 25, Credit and Fictitious Capital. Yet curiously, the term itself appears only twice in the main body of the chapter, and on neither occasion is it Marx himself speaking. So the chapter has the term fictitious capital, but when you look at the chapter, the only times when it appears, Marx is himself not speaking there. The first occasion is an excerpt from the Yorkshire banker Leatham, who as early as the 1840s discusses the humongous circulation of bills of exchange, adding that this was what today we might call a completely unregulated market. Quote, "The bills of exchange are not placed under any control, except by preventing the abundance of money, excessive and low rates of interest and discount, which create a part of them and encourage their great and dangerous expansion." Then Leatham carries on by saying, "It's impossible to decide what part arises out of real bona fide transactions, such as actual bargain and sale, or what part is fictitious and mere accommodation paper. That is, where one bill of exchange is drawn to take up another running, in order to raise a fictitious capital by creating so much currency. In times of abundance and cheap money, this I know reaches an enormous amount." So that's a quote from Leatham, which you find in Capital Volume 3. So here, fictitious capital is used to refer to what Marx called accommodation bills, mere accommodation paper. That is, those bills of exchange that were either purely speculative or part of an outright swindle. The second occurrence of fictitious capital in chapter 25 comes in a parenthesis inserted by Engels, who described the speculation in bills of exchange that involved massive overtrading to India and other parts of Asia in 1847 as, quote, "a method of creating fictitious capital," and, quote, "a fraudulent procedure to boot." Marx himself refers to this as, quote, "swindling in the East India trade, where bills were no longer drawn because commodities had been sold, but rather commodities sold in order to draw bills which could be discounted and converted into money." For Marx, this was a credit swindle, as he called it. And he himself was careful to describe it simply as a system of fictitious credit, a method where, quote, "fictitious credit was created by means of accommodation bills." This is in a piece that he wrote for the New York Daily Tribune in 1858. He states there, quote, "The latter were discounted chiefly by joint stock country banks, which rediscounted them with the London bill brokers. The London bill brokers, looking only to the endorsement of the bank," that's the Bank of England, "not to the bills themselves, in their turn relied not upon their own reserves, but upon the facilities afforded to them by the Bank of England." So in some sense, the bill broker is the key financial figure. He's the linchpin of this whole financial system. Now this introduction, I hope, has done three things. First, it suggests that chapter 25 is not where we should look for Marx's understanding of fictitious capital, even if the chapter heading promises something in that direction. Second, that bills of exchange were pivotal to the nature of Victorian capitalism. And third, that the financial system of the city, that's the City of London, involved an entire interlocking city of London brokers, banks, discounting and accepting houses, and of course the Bank of England. It was the bank that stood behind the London bill brokers, or discount houses as they came to be called, and it was the bank's last resort facility that in some sense sustained what Leatham had called the enormous superstructure of bills of exchange. Now, it's in chapter 29, not chapter 25, but 29, which is called Banking Capital's Component Parts, that we get a better sense of what Marx means by fictitious capital. Here he disaggregates banking capital into one, cash, in the form of gold or notes, and two, securities. So the two main components of banking capital are cash and securities. The latter, that is securities, may again be divided into two parts. Commercial paper, current bills of exchange that fall due on specified dates, their discounting being the specific business of the banker, and public securities, such as government bonds, treasury bills, and stocks of all kinds, in short, interest-bearing paper, which is essentially different from bills of exchange. So he divides banking capital into cash and securities, and he subdivides securities into commercial paper and public securities. For example, shares, the sort of shares people buy in the stock market, would form part of public securities. And Marx adds, mortgages too can be included in this category, namely under interest-bearing paper. Now, the distinctive feature of this class of assets, the various types of interest-bearing paper that Marx refers to, is that they represent, quote, claims, legal titles to future production. Either a claim to certain sums from the overall proceeds of taxation, in the case of government bonds, treasury bills, and so on, or a claim to a share of company profits. In either case, the capital value of these securities is purely fictitious, since it bears no relation to the actual determination of value in the production and circulation of commodities. Marx himself identified the formation of fictitious capital, that is, the peculiar determination of its market value, with capitalization. But of course, in modern financial markets, the value at market prices of securities like credit default swaps and most derivatives has nothing to do with capitalization in that sense. All the same, quote, the greater part of this money capital is purely fictitious, Marx says, in the sense that its money value is, as he says, completely fictitious. So what is fictitious about fictitious capital is its value. As he says, the greater part of this, in the sense that the greater part of this money capital is purely fictitious, in the sense that its money value is completely fictitious. Their values can rise and fall quite independently of the movement in value of the actual capital to which they are, or more precisely may be, titles. The capital that is fictitious is money capital. And at the end of chapter 30, Marx even suggests that fictitious capital is interest-bearing paper par excellence, more than bills of exchange. Two final points. Fictitious capital circulates as money capital on the financial markets. And, quote, in all countries of capitalist production, there is a tremendous amount of so-called interest-bearing capital or moneyed capital in this form. Again, quote, in times of pressure on the money market, these securities are put up for sale in massive quantities to be converted into money. Again, quote, their depreciation in a crisis is a powerful means of centralizing money wealth. And Marx calls this a devaluation of money capital, devalued securities. So let me come back to the bill of exchange by a rather circuitous route. The re-internationalization of the city from the 1960s was bound up with the rapid evolution of a new international money market. Because remember, what happened was, after the First War, we went into a kind of crisis, then a short-term boom, then a prolonged depression, and then war again. So the whole period from 1914 down to 1945 is a kind of tragic interlude in the history of modern capitalism, an alternation of horrific wars with a massive economic depression or crisis, culminating in the slaughter of the Second World War. So it's a sort of long, prolonged interlude in the history of capitalism until you come back to a kind of international economy in the 1950s. The re-internationalization of the city from the 1960s was bound up with the euro-dollar market, the founding stone of today's international system, as Gary Byrne calls it. An unofficial, unregulated, and unrestricted international money market dealing in expatriate dollar deposits held in a very liquid short-term form. A wholesale money market that led not just to the restoration of the city's fortunes in the 1960s, but even more dramatically to the re-emergence of global finance, which is in fact the title of Burns' book. The book I'm quoting from is by a guy called Gary Burns, and it's called The Re-Emergence of Global Finance. It's absolutely crucial to understanding the financial markets today because it provides the missing link between the latest state of the financial markets and everything that happened earlier. It was British merchant banking which formed the crucial link enabling the re-emergence of global finance to occur. What the creation of the euro-dollar market did in the late 50s was provide the city with a way of acting as a center of international finance without imposing a strain on Britain's depleted gold and currency reserves. It was restrictions on the use of sterling that triggered the great expansion of the euro-dollar market, which took place towards the end of 1957. What emerged was a merchant bankers market that inherited a large part of its institutional structure and techniques from the city's Victorian system for financing international trade. So in a sense, the 50s and 60s, in particular the late 50s and 60s, are the kind of missing link between Victorian capitalism, which plunges into crisis around 1914, and the modern financial markets. Looking at it in a kind of long historical sweep, here is the link in the late 50s and 60s, and spatially speaking, it's the city of London, which is the crucial intermediary in all this. As Burns says, the advent of the euro-dollar market finally allowed the city to regain its autonomy lost in 1931. But it's just as interesting, as he tells us repeatedly, that the institutional framework of that market was borrowed from the Victorian London bill market by city traders like Sir George Bolton, suggesting an astonishing continuity in the structures of British capitalism. So you have bills of exchange dominating the financial markets and the financial system of the 19th century. You have the modern financial markets that I shall come to towards the end of this paper. But in between, you have the redeployment, the retotalization of those institutional structures and techniques to allow global finance to re-emerge through the euro-dollar market. So you've got a fairly coherent narrative here. Now, bills of exchange drawn on London financed most of the world's trade in the 19th century. Marx described the bill as the basis of the credit system, and in volume 3 he even describes capitalism as a system of production where the entire interconnection of the reproduction process rests on credit. So basically, if you read volume 1 and you stop there, you cannot understand capitalism, because volume 1 is all about the labor process and the extraction of surplus value from living labor. But if you stop there, you do not get a sense of the real dynamics of capitalism as it works in reality. You have to go to volume 3 in the end, because Marx says that the entire interconnection of the reproduction process rests on credit. Bills of exchange could be sold at a discount to face value in order to obtain immediate funds, and because they enjoyed such ready negotiability in the London bill market, they were an ideal means of financing world trade. To make the bill of an overseas merchant discountable on the London money market, a London merchant bank would put its signature on it, thus, quote, accepting or guaranteeing it. Accepting was a commission business controlled by leading merchant banks of the ilk of Barings and Schroders. These banks were also known as accepting houses. The Bank of England stood behind the bill dealers or discount houses, prepared in extreme circumstances to rediscount their better quality bills. Because the bank was prepared to do this, the houses were able to finance their massive bill portfolios with money that could be withdrawn virtually at a moment's notice. That is, from the call money market. With the phenomenal growth of deposit banking in Britain in the 1850s, the joint stock banks began to employ an increasing portion of their reserves at call with the city's bill brokers or dealers, and were willing to do so because the Bank of England would be willing to discount the bills in effect acting as lenders of last resort to the dealers. So the banks, the high street banks, so to speak, mobilize deposits from retail savers, from individuals, a vast mass of people across the country and so on, and then they put that money into the call money market, which is overnight loans, making it possible for the whole bill market to operate and function. And of course, behind all that stands the guarantee, the implicit guarantee of the Bank of England. Relations between discount houses and joint stock banks were intimate and continuous, for the bill brokers not only sold large lines of bills to the banks, but borrowed substantial sums of money from them on a day-to-day basis. Now, bills of exchange were used both to finance the trade in opium and as a means of remitting opium profits to Bombay, Calcutta and London. In other words, without the bill of exchange, no opium trade, okay? No opium industry without the bill of exchange. Till the early 1830s, the most sought-after bills were those issued by the East India Company on Calcutta or on the Court of Directors in London. Of course, in addition to company bills, there was a vast volume of private paper in circulation. Jamshedji Jijiboy, almost certainly the biggest dealer in opium on the Indian side and a major client of Jardine Matheson and Company, with whom in the 1830s he was transacting more than £1 million worth of business, that's in the 1830s, £1 million worth of business, remitted about £150,000 each year to London through China, thanks largely to the good offices of William Jardine. As the late John F. Richards suggested, already by the 1820s, quote, the greater part of private returns from the opium trade that returned to India went to the mercantile communities of Western India, not Bengal. Private returns, i.e., they surpassed the returns to the company, to the East India Company. The greater part of private returns from the opium trade, of all the private returns to the opium trade, the greater part of that went to the merchant communities in Western India. The huge volume of Malwa opium that flooded the Chinese market in the 1830s was dominated by indigenous merchants, that's Indian merchants. The opium lobbies in the so-called native states in what is today Madhya Pradesh, and the big dealers at the Bombay auctions. Bombay's fortunes were built on opium, as Amar Farooqi argues in Opium City. When in 1831 the company finally relented and allowed Malwa opium to be shipped through Bombay on payment of a transit duty, Jamshedji ran, quote, a massive combination to monopolize the Malwa trade, seeking to have as much of the supply as possible consigned to Jardine Matheson at Canton. So successful was this combination, writes Asiya Siddiqui, that at its height, something like a third of the entire quantity of opium to leave the shores of Bombay was going to the warehouses of Jardine Matheson in China. As it happens, the leading houses in the China opium trade were also by far the largest of the British traders in this period. By the 1860s, Jardines were handling close to £300,000 worth of opium on commission each year, apart from investing heavily on their own account. Just as a commission business, they were getting £300,000 from the opium trade. I want you to try and see this as a connected, integrated system. The city of London in one part of the world, the big Indian merchants in Western India, okay, sourcing their opium from Malwa, and then Jardine Matheson and the other UK firms based in China, okay. I want you to see this, to visualize it as a circulation of capital, as an integrated, connected system. The private English in China, an expression laced with irony, since there was a preponderance of Scottish names among them, had the backing of the great East India houses, a number of old and powerful firms in the city of London. Jardine's list of merchant banking houses whose paper they endorsed included all the big names. Most of these could be drawn on for large sums. With Fairley and Bonham in London, Jardine's bills account doubled every year between 1827 and 1830. The expansion of Britain's eastern trade was largely developed by family and clan groups, organized as agency houses, a congeries of fluid partnerships that in principle at least drew the bulk of their profits from agency commissions as opposed to, quote, speculation or trading on their own account. All the agency houses depended on the powerful support of city firms like Fairley, who for their part competed vigorously to grant acceptance credits on international commodity business. Leading trading companies like James Finlay and Company could, quote, open any number of accounts for acceptance credits. For example, in 1871, the Glasgow head office of this agency, that is James Finlay, advised the Calcutta and Bombay branches that the Royal Bank of Scotland would cover acceptances to the extent of £100,000. But Finlay's also had accounts with the Bank of England and Baring Brothers, while the Indian branch had their own accounts with the London merchant banks. So you have a fairly complicated, well-integrated financial system working already by the 1820s and 30s. Now, Marx was thoroughly conversant with the nature of the bill market and how, for example, banks would create capital by reissuing bills of exchange, or how the London bill brokers carried on their enormous transactions without any cash reserves, and how the East India trade tied in with the financial mechanisms of the city, periodically blurring the tenuous boundary between trade and speculation. He also knew that the East India Company had, quote, rapidly converted the cultivation of opium in India and its contraband sale to China into integral parts of its own financial system, as he said in 1858. What is not there in Marx, at least in so many words, is a totalizing picture of how the peasant hinterlands of British capitalism, and I don't mean British peasants, I mean the peasant hinterlands of British capitalism which lay here, were integrated into the expansion of capital, whether that of the trading houses that were connected with the city or of industry itself. And opium is a good example to look at, not just because it was probably the largest commerce of the time in any single commodity, as Greenberg describes it, but because the hesitation that stopped Marx from proposing an integrated model of accumulation is reflected crucially in a passage that deals precisely with opium. Since this is a crucial passage, I shall cite it in full. So what was Marx's hesitation? Why didn't he go one step further and build this sort of totalizing model of the accumulation process? In a contribution to the Critique of Political Economy, 1859, when discussing the decisive function of money as means of payment, Marx writes, in the transaction M to C, money as a real means of purchase may be alienated, thus realizing the price of the commodity before the commodity is handed over. This happens, for instance, in the well-known form of advance payment, also in the form of payment used by the English government to buy opium from Indian ryots, and is largely used by foreign merchants living in Russia to buy goods produced in that country. In these cases, however, money functions only in the familiar form of means of purchase and therefore requires no new definition. See, he says it's means of purchase, okay, as if it's a simple transaction between buyer and seller, okay, and therefore requires no new definition, because Marx, in the contribution to the Critique of Political Economy, is defining the different functions or aspects or determinations of money. And so when he comes to money as means of payment, he uses the example of the advance payment system, which was the basis of the opium trade, but he seems to think that money here requires no new definition, it is simply means of purchase. And this point, Marx adds a footnote. So it's the footnote which is so striking. He says, of course, capital too is advanced in the form of money. And the money advanced in these advanced payments may well be an advance of capital, but this aspect doesn't lie within the scope of simple circulation. Very interesting footnote. Capital too is advanced in the form of money. And it's possible, he says, that the money used in the opium trade in the form of advance payments may well be a circulation of capital. Okay. In short, Marx is uncertain whether to treat the advances under which so-called Bengal opium was grown in India merely as a set of transactions between a mass of independent producers and their single buyer, the government, or as a circulation of capital. He knew that the opium monopoly, or that part of it relating to the cultivation of poppy, was based on a mixture of compulsion and enticement. The British government, he wrote, quote, compels one part of the Indian ryots to engage in the poppy culture, entices another part into the same by dint of money advances. So he was perfectly familiar with the system at work in the opium trade. It sort of compels one part of the peasantry in India to grow poppy, and it entices another part by dint of money advances. This was a view abundantly supported by the evidence proffered to the Royal Commission on Opium as late as the 1890s. Bengal opium was grown in an elongated tract along the eastern Gangetic Valley in present-day eastern UP and Bihar, and the bulk of the evidence that I quote now in the coming paragraph relates to this region. So basically, the Indian opium industry is divided into these two market segments, if you like. Malwa opium in the west, handled by private capital, by private merchant capital, and Bengal opium in the east, which is a monopoly of the East India Company. Poppy was grown in the richest fields of the village, on the rich loams, and needed constant care and labor for nearly 5 months, down to the lancing of poppy heads and scraping of opium, which took about a fortnight. I'm quoting all this from the famous Royal Commission on Opium report, 1890s. It's easily accessible. The cultivators are generally poor, and they make the members of their families work hard. Said one clergyman, since cultivation of the poppy needed 2 or 3 times as much labor as the other spring crops. Quote, poppy is a crop specially suited to small holdings where a large return has to be gained by minute and laborious cultivation of a small area. This is the perfect Chayanovian household, the peasant household that conforms to Chayanov's logic. You know, you squeeze a living out of the soil, you work really hard, you drive your family, including the children, to extract that income which matches what Chayanov called the family labor income, okay? And what this evidence is suggesting is that poppy is a crop ideally suited to these kinds of households. Nearly all the peasants engaging for opium with the state were either kachis or koiris, subcastes of skilled gardener cultivators who excelled in raising the specialist heavy crops of tobacco, vegetables, and opium. The sub-deputy opium agent dealt directly only with the village headman, who in turn mobilized lists of cultivators willing to enter into the engagement to sow. So I told you to visualize a circulation of capital, an interconnected system. So the first segment of that circulation, you know, the financing of the trade, and by the time you come to what happens to the money, how is it disbursed into labor, so to speak, okay? That's the part one is talking about now. That's further subdivided into the company, the sub-deputy opium agent, that's the company bureaucracy, deals only with the village headman, not directly with the cultivators. And he, the village headman, in turn mobilized lists of cultivators willing to enter into the engagement to sow. New advances were dispersed at the end of September through these village intermediaries, and peasants sowing less than the area engaged for were liable to prosecution under Act 13 of 1857. To the opium agents, that is the government, what the cultivator entered into was a legal contract. So law is central to this picture, to the accumulation of capital. I mean, you know, the willingness of the cultivators, you know, to engage in sowing the crop, etc. It's all legally documented. It's all there. Richards describes the rates paid per seer of crude opium as a carefully calculated minimal monopoly price, usually 4 or 5 rupees a seer, much less in the early 19th century. So, you know, carefully calculated minimal price, because there was no competition in the market. There's only one buyer. That's the government of India, which is at that stage the company, the East India Company. No competition from other buyers, so the price can be kept specifically, deliberately low. There was solid testimony throughout the century that opium was cultivated at a great loss to the mass of those engaging for it. All right, great loss to these, especially if you do a kind of Chayanovian calculation of the family budget, of the peasant family budget, then you end up with a deficit. So why do they grow it? The commission asked one minor zamindar. Because the government advances money, was his main response, which is absolutely right. The advances were a powerful inducement because the vast mass of peasants in these parts of the country were tenants at will, subject to the exactions of both landholders and moneylenders. They could never pay their rents but for the opium receipts, said one sub-deputy opium agent in the Bihar agency. See how complicated the picture starts getting at the local level. We're talking about labor now. We're talking about peasant labor, and we're bringing in moneylenders, a rent system, and tax payments. Okay, all the fundamental determinations of political economy are at work here. They could never pay their rents but for the opium receipts, says this opium agent in the Bihar agency. As punctuality in the payment of revenue is rigorously enforced, the smaller landlords would be in serious difficulty were it not for the opium advances to the riots upon which the Mahajans advanced the installments of rent payable to the Zamindars. Phenomenally complicated. All sorts of interlocking interests at work here. Okay? Money lenders, Zamindars, peasant households, opium agency, the state, and then we'll come to the auctions later, etc. But it's a hugely interconnected and integrated system at work. The advances were interest-free, that is, their sole purpose was to establish a legal claim on the peasants' labor time, which in practice meant a substantial quantity of unpaid family labor. Balls of crude opium were weighed and tested for adulteration around the middle of April. So the advances are dispersed in September. By the time you come to April, after the labor process is more or less over, the balls of crude opium are tested by the company agents for adulteration around the middle of April, and the agreed rates paid only for the finest quality crude. So a lot of the stuff was being rejected. No payments were made despite the fact that labor had been invested in production. The opium was then placed in earthen jars which were sealed and dispatched to the factory in consignments of 100. The manufacture of provision or export opium went on from May to the end of July. Opium from the Bihar factory contained 75% morphine, that from Bengal 71%, following a process called alligation. That's with an I in the middle, not an E. That is the mixing opium of different consistencies. Opium cakes were then packed into chests of about 130 to 40 pounds at the rate of 500 chests a day, and these dispatched from the factory to Calcutta by special trains. The opium was then auctioned at Calcutta to private traders like Jardine Matheson when they traded on their own account. So the merchant comes back into the picture. The big kind of East India agency houses come back into the picture at the auctions because the East India, the Bengal opium is essentially a government monopoly which supervises the labor process. Okay? So I wish to convey this image of an integrated financial and economic system where the city of London is pivotal to the trade. The trade is essentially based on the production of something like 1 million, at least 1 million peasant farm households are involved in production of poppy and so on. The government is the sole claimant to all of this, and then the government auctions the stuff in Calcutta. So why does opium matter in this picture of 19th century capitalism? Because it was India's largest export item for most of the 19th century, a fact which for some reason isn't sufficiently publicized, that what today is called heroin, okay, was India's largest export item for most of the 19th century. Her chief source of the large annual inflows of bullion from China, and the one commodity more than any other that financed a substantial part of the UK's trade deficit. In the 1870s and 1880s, an average of over 90,000 chests or 5,700 metric tons of opium left Indian ports every year. You translate that into modern terms and you put a kind of street value on it. It's just a phenomenal amount of heroin going into China, thanks to our country, which is, kind of at the center of this imperial system. On the East India Company's estimate, the Chinese were importing enough opium to supply over 2 million smokers in 1835. By the 1880s, the massive escalation of exports from Calcutta and Bombay had triggered the emergence of domestic supply areas in the south and west of China. And the scale of consumption was certainly closer to the 40 million smokers estimated by some scholars than the simply not credible figure of 2 million cited by the head of the Imperial Maritime Customs in 1881. So by the 1880s, you're more likely to have a market size of around 40 million smokers. Now, not all of them are necessarily addicted to the stuff, but let's say the vast majority are, okay? So even if 30 million Chinese individuals are addicted to heroin, the system has to keep going because it's absolutely pivotal to the nature of Victorian capitalism. William Jardine and James Matheson were both Whigs and strong advocates of a showdown with the Chinese authorities in the interest of securing what Jardine described to Palmerston as, quote, liberty to trade with the northern parts of China. If we can get it, he said. As early as 1834, James Matheson had denounced the new Foreign Secretary, the Duke of Wellington, as what he called, quote, a strenuous advocate of submissiveness and servility. Why? Because the guy wasn't so militaristic. He didn't want a showdown with the Chinese authorities. So he became, in the eyes of James Matheson, a strenuous advocate of submissiveness and servility. Palmerston, who was Whig Foreign Secretary from April 1835 to September 1841, was altogether more sympathetic to the commercial interest at Canton. When the showdown finally came in 1839, Jardine was on his way back to Britain. Arriving in London in September, he went to see Palmerston, and as J.Y. Wong writes, Wong's book on opium is the best book there is. It's called the Arrow War or something to that effect. As he writes, literally masterminded the government's approach towards China and the Opium War, down to details such as the size of ships to be deployed and the terms of the treaty to be proposed to China, leaving blank only the names of the islands to be occupied and the amount of the indemnity to be exacted. So what happens? Jardine returns to London in retirement, so to speak, goes to see Palmerston almost immediately and masterminds the blueprint for the First Opium War. Seldom has a private business had more effect on public policy, notes Sir Robert Blake, the company's biographer. That's the biographer of Jardine Matheson. But Jardine was the epitome of a whole constellation of interests connected with the city, where, of course, he was widely respected. Those interests and the peculiar nexus between the city and the Foreign Office were even more strident in 1857, when the chief London firms connected with the China trade, some 20 in total, a deputation of literally hundreds of leading bankers, merchants, ship owners and brokers of Liverpool, and even Lloyds of London, rushed into battle, armed with, quote, the strongest expressions of confidence in Lord Palmerston. To open China was the slogan under which the Arrow War was fought. This is what is usually called the Second Opium War in the late 1850s. The slogan was to open China. Does it remind you of something more recently, say in the last 20, 30 years? You know, emerging markets, etc., etc. To open China was the slogan under which the Arrow War was fought. The same wild vistas of an immense extension of trade, dreams of an inexhaustible market, as Marx commented with his usual dour realism a year later. Now, in Figures of Dissent, a key argument of Perry Anderson's revolves around the notion of a disjuncture between the city and nascent domestic industry. This is, of course, the famous Nairn-Anderson thesis about the nature of British capitalism, that essentially the city and the manufacturing interests in British capitalism are very distinct, and one has always been subordinate to the other. If so, it certainly wasn't obvious in either of the Opium Wars when the Manchester associations, that is the manufacturers' lobbies, were a vociferous part of the war lobby. Okay? So both the Opium Wars saw the manufacturing interest being a very assertive and vocal part of the campaign for war. All the same, Anderson's general thesis that the nature of British capitalism has been irreducibly shaped by what he calls the core operations of the city as a complex of British capital seems scarcely controversial to me. In other words, I accept the thesis. I accept Anderson's view about the nature of British capitalism. The only sector of manufacturing that has ever really mattered to the British state is Britain's defense industry. When Sindh was annexed in 1843 and the massive flows of Malwa opium deflected from Karachi to Bombay, the income from transit duties alone could exceed 2 to 3 million pounds in the 1860s, because remember, the company refused to allow the private Malwa trade to be routed through Bombay. When they finally relented, they relented at a price, and the price was that these guys would be willing to pay transit duties. The revenue that the state collected from transit duties alone was 2 to 3 million pounds in the 1860s. And for that, of course, the annexation of Sindh was crucial, because they couldn't enforce the revenue, they couldn't enforce the payment of transit duties as long as it was possible to ship the stuff through Karachi. But once Sindh is annexed by the British state, then Karachi is no longer a viable exit route for the opium, and so they're actually able to enforce the transit duties, okay? Britain's occupation of Egypt in 1882 had more to do with the bondholders than any conceivable manufacturing interest. The bondholders are now in possession of Egypt, the radical writer Frederick Harrison said at the time. The annexation of Upper Burma in 1885 was again linked to powerful commercial and financial interests connected both with the London Chamber of Commerce and with the Rothschilds. And certainly the 1880s were one of those seasons of general self-delusion, as Marx called them, when a plethora of capital gushed into every conceivable channel. The city poured billions in present-day terms into South American securities, and its speculations in Argentina left Barings with liabilities that threatened to crash the entire financial system in 1890. As the city's historian tells us, not only would the failure of the city's leading accepting house inevitably bring down a host of other firms, including all the discount houses, but the very status of the bill on London would be threatened, and thus the preeminence of the city as an international financial center. In other words, Barings overinvested, massively invested, speculatively invested in Argentine securities, and the whole thing was threatening to crash and bring Barings down. If Barings fell, the whole financial system of the city would collapse. What Barings faced was a liquidity crisis, and the solution cobbled together over one tense week was a rescue package that coordinated infusions of capital from the government, the bank, and the city. Had Barings been allowed to collapse, most of the great London houses would have fallen with them. We're talking about a period like 1890, okay? A major financial crisis affects the city. And what Rothschild says is, had Barings been allowed to collapse, most of the great London houses would have fallen with them. About £6 million worth of bills are drawn upon London daily, and an enormous proportion of this business passed through their hands. Okay, so let me fast forward by a century to a financial world that is vastly more complex and more integrated globally, okay? I've given you the picture for the opium side and tried to suggest the degree of interconnectedness of capital there and how labor fits into that. It took barely a decade, 87 to 97, roughly 1987 to 97, for the American investment banks to break the entrenched positions of the UK merchant banks. Does anyone talk about UK merchant banking today? No, it's disappeared. It's been swallowed wholesale by the American investment banks. In a final assault around the mid-1990s, 6 of the city's top investment banks were sold to overseas competitors in little more than 18 months. The British merchant banks were like Eric Santner. Eric Santner wrote about fascism. He's a scholar who wrote about fascism. He used the term stranded objects. But they were like Eric Santner's stranded objects in the high-octane world of the 1980s, when traders on the fixed income side started driving the profitability of Wall Street firms, and banks like Bear Stearns became major underwriters of mortgage-backed securities. Now this is the fixed income side. It's the bond markets essentially that matter in the 1980s. I mean, equity is not in play at all, okay? Mortgage securities were bonds created out of pools of several thousand mortgages that entitled the bearer to a share of the cash flows from the pool. Securitization creates fictitious capital, and mortgage bonds were a good example of how the US investment banks could actively create markets for fictitious capital almost overnight. What was striking about the frenzy of innovation that seized the banking sector in the 80s and 90s was the sheer rapidity with which such markets were being created and expanded and tied into each other. Collateralized mortgage obligations, CMOs, were created out of mortgage bonds which had been created out of mortgages. Synthetic CDOs were fabricated out of credit default swaps on different tranches of other CDOs. And credit default swaps preyed on a host of other markets, notably CDOs made up of subprime mortgages and more recently the sovereign debt markets of the Eurozone. Now all these acronyms, they're kind of alarming, CDOs and CMOs and so on and so forth. Essentially, these are simply very elaborate forms of debt, okay, or credit if you like, which are being devised by people in the investment banks, by people using mathematical models and computers to try and increase the complexity of these financial products as they call them. Credit default swaps are contracts that enable one side to hedge a long position, but hedgers need speculators to take the other side of the trade. And in 2006, when the total notional value of the CDS market hit $26 trillion, up from just 800 million in 2001, well over half of the CDS bets outstanding were pure speculation by people who didn't hold the underlying assets. So this is one of these financial markets we're talking about, is the credit default swap market. It's by far the most active market today, I think. Now in financial derivatives and globalization and the globalization of risk, Lee Puma and Lee, the authors of that book, suggest that the overaccumulation of manufacturing capital in the US economy generated an abundance of speculative capital. I think it's a plausible link. Essentially, the crisis of overaccumulation which affects the advanced capitalist countries by the late 70s and 80s is generating a turn to finance. The idea that an excess of speculation stems from a lack of profitability in the wider economy is of course an old one and is found in different ways in John Stuart Mill, Marx himself, and Henrik Grossman. In his classic work, Grossman argues that the plethora of capital that builds up as capitalism is increasingly characterized by an absolute overaccumulation of capital is released partly through the export of capital and partly by enormous bouts of speculation on the stock exchange. These are the two crucial mechanisms that reduce the impact, reduce the pressure of overaccumulation. What is a crisis? A crisis is an overaccumulation of capital. Why overaccumulation? Because the mass of capital is too large in relation to the rate of profit, of exploitation to justify any further investments. Too much capital has been invested. The way to stem the impact of that crisis is partly by exporting the capital to countries where you can sustain profitability, hence emerging markets, globalization, etc., and of course enormous bouts of speculation on the stock exchange. Grossman said this in a book written around 1930. These are the mechanisms by which a complete collapse of profitability is averted. These general determinations are fundamental. In other words, Grossman's theory of how the financial markets absorb a large part of the surplus capital that's been generated by the overaccumulation of capital, I think is correct, but it doesn't help to contrapose them, as Grossman does, to Hilferding's comments on speculation in a remarkable chapter of Finance Capital. This is one of those cases where one Marxist intellectual bashes another Marxist intellectual quite unjustifiably. I mean, what Hilferding was saying about speculation in Finance Capital is absolutely brilliant. It anticipates a lot of what happens later. There was no reason for Grossman to lay into him and to criticize him for that. In fact, it's a theory which can easily be integrated into Grossman's overall explanation. Not only is financial speculation characterized by a massive use of leverage and by that's what Hilferding calls the greatest possible rapidity of turnover, what Marx in the Grundrisse calls circulation without circulation time, but no less importantly, speculation, says Hilferding, has an objective social function under capitalism. This, if you like, is the most important argument in the lecture, that speculation has an objective social function under capitalism, namely to provide liquidity to the markets for fictitious capital, to keep them open for business at all times, and so give money capital as such the possibility of transforming itself into fictitious capital and from fictitious capital back into money capital. If you like, this is a circuit peculiar to Hilferding. Marx didn't discuss it in this particular way, of money capital being transformed into fictitious capital, retransformed into money capital. But it's speculation which gives the liquidity that drives the whole system and allows this to take place. Now, these are massive and highly concentrated markets. At year-end 2006, the top 10 counterparties accounted for 89% of all CDS trades on a notional basis. I hope I'm not losing you here. There's not much more of this stuff coming up, okay? But the top 10 counterparties accounted for almost 90% of CDS trades, that's credit default swaps, on a notional basis. The $72 trillion worth of credit default swaps outstanding in 2008 was held by 17 banks, with Lehman holding 7 trillion of them. Or take this statistic. In the first quarter of 2010, the notional value of derivatives held by commercial banks in the US, that's your high street banks, the banks that you put your deposits into, was $212.8 trillion. We're talking about trillion here. That's 1,000 billion. It's a different order of magnitude entirely. Of the 1,000 odd commercial banks that submitted information on their derivatives exposure, the top 5 claimed 97% of this notional value. Enormous concentration in these markets. The global capital markets work on overnight loans. That's where the call money market comes back again. You know, the bill market and so on and so forth. It comes back into the picture now. The global capital markets work on overnight loans. Unlike commercial banks, the investment banks do most of their funding overnight in the repo market, using the assets they hold as collateral. The collapse of the Bear Stearns hedge funds that triggered the first round of financial panic in June 2007 was brought on by margin calls from the repo lenders, with some lenders like Lehman and Credit Suisse seizing collateral to sell into the market. So it's the overnight lenders who started, putting the pressure on Bear Stearns, on these hedge funds, saying that, look, we don't think your assets are that great. You need to increase the margin that you post. The Bear hedge funds had a total of $11.1 billion in repo financing from 16 Wall Street firms. Remember, these are overnight loans, okay? 11.1 billion of this in repo financing from 16 Wall Street firms. And of course, the irony is, as William Cohen tells us, the very same banks that were repo lenders to the funds were up to their eyeballs in the same illiquid mortgage securities that the funds had. So it was completely dishonest, downright dishonest for these lenders to start putting the pressure on the hedge funds, because they were holding the same assets basically. It was the evaporation of liquidity in the short-term money markets in the middle of 2007 that signaled the emergence of a major crisis and forced the European Commercial Bank to inject 95 billion pounds into the overnight lending market. Bear's own collapse in the spring of 2008 was brought on by short sellers speculating in the credit default swap market and telling counterparties at other firms they had concerns about Bear's liquidity and solvency, which drove the cost of spreads wider and made funding more expensive. Now these short sellers, they're speculators essentially, but they're spreading rumors about, how liquid and how solvent is Bear Stearns itself. By the fateful second week of March, Bear's overnight lenders were all gone, and the hedge funds had started pulling their prime brokerage accounts from the firm. On Thursday of that week, that's March the 13th, 2008, Bear went from solvent to dead and was scooped up by JP Morgan Chase for $10 a share. So the financial panic starts in the middle of 2007 with the collapse of these two hedge funds associated with Bear. And then the next round of financial panic is in early 2008 when Bear Stearns itself collapses. Why does it collapse? Well, essentially because the prime brokerage accounts are not willing to deal with the firm. They're pulling their money from the firm, and the short sellers are speculating in the credit default swap market. Obviously, it's in their interests to destabilize Bear Stearns because they're putting their bets against Bear Stearns in that market. The big winners in the crisis were Goldman Sachs and JP Morgan. There are always winners in a crisis. When we talk about a crisis, we think there are only losers, but there are always winners in a crisis. There were many at Bear Stearns who believed that Goldman fomented the negative sentiment and trading that doomed Bear Stearns in its final week. I'm using William Cohen's brilliant books, one on Bear Stearns, one on Goldman Sachs, as the basis of this narrative. They're in paperback and easily available. Goldman supposedly bought puts, shorted Bear's stock, and or encouraged hedge funds to pull money from the firm. In short, engineered a run on the bank. The demise of Lehman some months later in September was clinched by the extraordinary fact that the Fed agreed to expand the collateral that investment banks could pledge as part of its suddenly contrived rescue facilities, but denied Lehman access to the discount window. So they invent a facility which will enable the banks to post new forms of collateral, so to speak, new assets up as collateral, but they deny that facility to Lehman. No public money, Hank Paulson said at the time, yet Paulson had no trouble putting billions of taxpayer dollars on the line for both Bear Stearns 6 months earlier, because he was the one who brokered the deal for Morgan Chase to take over Bear Stearns, and AIG, the giant insurer, 2 days later. So Bush's government was very selective in the way it approached the banking crisis. It allowed Bear Stearns to basically be bought up. It allowed Lehman to collapse, and on the other hand, it tried its best to save AIG, and it allowed Bear Stearns to collapse essentially, and to be taken over, to be bought over by JP Morgan Chase. So there were three banks. They had dealt with them in very different ways. On September 16, 2008, the federal government poured $85 billion of taxpayer money into AIG to keep it from falling into bankruptcy. That's the great American insurance company, and in effect took over the company. The Fed gave the counterparties 100 cents on the dollar. So basically they didn't lose anything. AIG was brought down by its exposure to credit default swaps, since it was consistently on the wrong side of the trades. Okay? Bad investment decisions. Bear and Lehman by their vast accumulation of assets that soon became worthless. The ability to take short positions through the credit default swap market was a major part of the way the banking crisis played out. For example, by allowing Goldman to become significantly short the market by the end of January 2007, when the other banks were still collecting vast amounts of collateral to ram into their CDOs. Goldman's net exposure to the mortgage market was virtually flat by March 2007. They began selling all these toxic assets in December 2006. And by March 2007, their positions had been more or less evened out. And by April, it was aggressively marking down its residual mortgage securities with lethal consequences for the other firms. Why? Because if you bring down the price of a security from, say, of the collateral from 100 cents to 60 cents, then those guys have to post more collateral in order to retain their loans in the overnight market. So they were effectively engineering a crisis in all the other companies. Al-Fatah has argued that credit default swaps are perfect instruments for speculation on defaulting sovereign debts. And indeed, that speculators have been targeting the Eurozone by attacking the weakest link in the chain in the European periphery. All this turbulence in Ireland, in Greece, in all the weak links in the Eurozone, a lot of that turbulence is effectively a reflection of the kind of bets that are being placed, enormous bets, vast volumes of money capital in the credit default swap markets. They're betting against these countries. They're betting on defaults. They're betting on them going into bankruptcy and so on. There is now enough evidence to suggest that as countries move into distressed debt situations, the bond market adjusts to the CDS market and not the other way around. In other words, it's the CDS market, speculation in the CDS market, that influences bond prices, drives up the cost of capital for these countries, which then have to renegotiate the loans at much higher levels of interest. In other words, speculators in the credit default swap market exert a major influence on sovereign bond spreads, with the devastating consequences this has for the mass of the population in countries like Greece and Spain, and of course elsewhere as well. Thanks.